All right. Well, good afternoon, everyone. Joe Pochodyniak here, along with Ken Reid of McNichol and Associates Asset Management. We're going to take you through our alternative program here, the Alternative Asset Trust. We're going to explain quite a bit about the program to you today, and hopefully get you up to speed on what it is that we're hoping to achieve with this program, as well as how you can apply it in terms of your overall investment plan. This particular program that we run has been in existence for a while now. And the way we've kind of sectioned it out is kind of coming in at it from a high level and then maybe opening up sort of the reason why we like alternatives as part of an overall portfolio, getting into some performance numbers and that sort of thing. And then I'll just sort of highlight some of the individual private companies that we're investors in. A lot of you may not know that we can and do invest directly in private companies as well as partnerships that hold private companies. But for now, let's get into it. I think this is going to be a lot of fun. Uh, Certainly for myself and hopefully for everyone. The disclaimer, we just draw your attention to the fact that we're certainly not providing any investment advice today with alternatives like private equity and hedge funds. They're kind of strictly OM exempt level securities. So definitely no direct advice here. But the good news is that's what we do for a living. So come in and check us out, and we'll be happy to give you some investment advice. And we've included our contact information at the end of today's podcast just to make sure you have it. So let's get going here. So this is the Alternative Asset Trust. We launched it in October of 2010. And what the trust is essentially a unincorporated, open-ended, unitized trust structure that holds three limited partnerships: the Mac 360 Fund, the Absolute Return Fund, and the Emergence Fund. And those funds are the LPs that go out into the private market to find and invest in deals in North American private real estate, hedge funds, and private equity. And we've crafted this structure together long ago to give you, our investors, the opportunity to participate in a lot of these private transactions that you might read about in financial media outlets and that sort of thing, but might not have been able to participate in them for a variety of reasons, good and bad. So we really put a lot of time and effort into structuring this thing such that it's easy for you to use. You and your financial planner, whomever, can refer to it very easily. The reporting is great. We put out a quarterly commentary for this, a dedicated commentary for the trust as well. And you can see that up until the end of this past March, not doing too badly. I would like that return figure to be just kind of in those lower double digits, but I'll take a 9.5, and 6.9 vol is about half the volatility that you would get in the stock market, and that's the S&P 500. If you talk about some of the more higher beta markets, like our stock market up here in Toronto, a lot of oil and gas and resources companies there, they can be a little bit more volatile. So when you compare it to those two main equity indices, we're really in good shape there in terms of the volatility metric. Now, we of course are highly biased, and I'm also a unit holder of the trust. So I'm not only that, I'm kind of conflicted, but periodically we do like to assess how we're doing relative to not just what we think and hope the trust should be doing, but also against a pool or a number of defined global benchmarks that we can refer you to, our investors, and hopefully our prospective investors. And it really gives you the confidence of knowing that you're in great shape. And you can see here in this particular schematic, we have the annual return figure on the vertical axis, the y-axis, and the volatility or the standard deviation on the horizontal x-axis. And you want to be heading to the upper left-hand corner of this particular slide as much as possible, as often as possible, and you can see that we're definitely no slouch in that area, certainly against a good number of established equity benchmarks, but also high quality bond indices and other aggregates in that sort. We didn't invent alternative asset investing, and neither did Yale for that matter. I think if you really dig into the history books, this goes back hundreds of years. But really, the idea of alternatives is the word alternative is alternative to mainly public market investments, the most common of which are stocks and bonds. Why we include the Yale Endowment Fund in this particular podcast is really just to highlight that just like a lot of investors, earlier in its earlier years, the Yale Endowment Fund had a very high allocation to stocks and bonds, and that worked great. They're not bad money managers. They weren't really missing anything. But since that time, as you know, interest rates have changed quite a lot. And that has led to a situation where, although investor return expectations have not really changed, the expectations or maybe the sensitivity around volatility definitely has. And so, with Yale, again, they started off being mainly public market investors, but in the subsequent 30, 40 years, they have gone and transitioned into being mostly a private equity or alternative asset manager. And this is over $40 billion now, $41 billion that they manage. They've done a very good job of it. And, here's another reason why we think this is an important area for investors to consider. That is the tailwind, right? The growth in this particular asset class that's getting a lot of attention from a lot of different investment groups, and we're excited by that. We like that, but again, we sort of have to be, I think, not only advocates but a voice of reason. You can really get into some fairly risky investments here, so just be careful. And again, if you have any questions, just feel free to contact us. But in this slide, Preqin, which is a private equity database, forecasts that by 2026, which really is just around the corner when you think about it, the industry as a whole will have about $23 trillion in sort of cumulative investments from asset managers, family offices, other established investment groups, and these private capital funds, have indeed done very nicely in terms of the rates of return. And really, we'll get into sort of why, one of the reasons why that is. There's a variety of reasons why that is, but we'll talk about one of them that you may be kind of excited to or surprised to hear our take on it. Pension plans and endowments have certainly led the way. So this is just a selection of some of the main Canadian pension plans and endowment groups. The Ontario Teachers Pension Plan, OMERS, the Canada Pension Plan. All of those investors have one thing in common, and that is they are no strangers to alternatives like private equity. Unfortunately, if you go down the maybe not just the dollar spectrum, but maybe the experience or the sophistication spectrum, the average retail investor does not really include much in the way of alternatives in their portfolio, or maybe they've got an equity long short ETF or something like a liquid alternative strategy, and they think that's good enough, I'm okay. And so we're just saying, there's much more to it than that. And it's important to be, mindful of not only your overall portfolio, but the position relative to the industry. And we're really well situated to help with that. The big thing about the outperformance that people talk about in private equity is certainly the what we call an exit multiple or an exit valuation. Those can be extremely high. They're not always high. But I think one of the things that private equity does well is there is sort of an embedded discipline in the process, right? There are a lot of long-term focused investors, sophisticated investors that, when they make a capital commitment, they can stick to it. And really, it doesn't matter what investment you're in, public markets, private markets, whatever, I think really the long-term focus or perspective is the best way to do this. Now, as you know, if you've been to our website, we don't have an entire building full of CFAs and business grads crunching numbers for us. We do have some of that, but we definitely rely on our strong global network of partners. And in private equity, in the world of alternatives, there's a lot of industry specific jargon, and I'm not a big fan of jargon and dropping kind of names that people don't know about. But essentially, what an equity sponsor is another firm, a private equity firm that has a strategy or an investment opportunity that they are essentially bringing to you, and you can choose to participate in it if it meets your investment criteria. By buying units of their private equity fund, or maybe it's a preferred equity arrangement, or maybe it's a convertible debenture. There's a variety of different ways that the investments can be structured. But the main thing is each one of these groups is on this list for a reason. They're very good, they're very experienced, and they have a lot of very smart people asking the detailed questions about the investments that are going down that are really important to know. And it's really key to ask those questions before you make an investment. Just taking a look at some of the dollar amounts that we're talking about, they are gargantuan. Some of these firms are huge, like I'm talking enormous. And others are what we would call mid-market. So mid-market is one of those areas of the global private equity space that we really, really like, because it allows us to say to our investors, look, we're bringing deals to the table that position your portfolio, your monies, in the same area as a lot of these sophisticated institutional groups, without having to kind of get into those really humongous private equity funds. Some of the ones like Starwood, great firm, nothing but the highest amount of respect for them. Blackstone's another one, and so on and so forth. Why we tend to avoid groups like that is a couple of reasons. One of which is leverage, right? With some of those huge deals, you need a lot of leverage, which is borrowing to sometimes make the numbers work. And in many cases with the mid market, those deals tend to sort of fly under the radar of these larger groups. Again, not saying anything bad about them. They got big for a reason. The reason is they're probably very good. But these groups are too, and many of them, as you can see here, are closed to new investments. So really what that means is they're not closed. You can contact them, reach out, tell them you're interested in learning more. They'll for sure get back to you. But they're not necessarily raising funds for a new fund offering that they're launching, or calling capital for an existing vintage of fund. That's kind of what closed means. And so, we're really pleased with this group. I don't know that a lot of our investors know this, but in some cases we've been, interviewing these groups for several years. We do like to see how their strategies work in the real world. Anybody can put together a spreadsheet with a bunch of numbers on it. And so again, before we come to our investors and say, look at what it is that we're doing, we want some really tangible evidence that these groups can make it in the real world. And that results in our program being, again, part of a well-balanced portfolio. That word balance gets used all the time in our industry. And unfortunately, it's a nice word to hear, balanced, right? It's sort of one of those neutral, nice words that doesn't rock the boat too much. But the question we sometimes ask is balance between what? And for many investors, the only thing that they're trying to ascertain when they talk about balance is the weighting of stocks to bonds, and so they're missing this really, really big and important piece of the pie. And you can see again, this particular structure of the trust, it's been in place for years. We put out two sets of financial statements for the trust, one of which gets the full blown audit, and again, just a really nice, compelling, and elegant way to access alternative assets without having to worry about monitoring tax filings, how you report on all of this. What are the underlying investments doing? That's all handled in-house by us. And then this is the second page, or the second portion of what we call our fun fact sheet, which just gives you some more information. I think the most important part about this is going to be the liquidity around the trust and private equity in general. One of the reasons why the risk return metrics on private investments tend to or can be pretty good is that everybody who gets a seat at the table stays at the table and sees the investment throughout its investing life cycle. They don't abandon ship and exit the strategy prematurely, so they are able to harness the value over the full investment cycle. Now, we like when the NAV of the trust kind of has this nice, long, smooth upward trajectory. It's not always the case. You can see in 2015 there was some upward volatility, which was great. That happened to be an investment that was made into a company that everyone now knows as Shopify. And when Shopify transitioned from being a private company to a public one, the floodgates opened, and more investors were able to buy shares of Shopify. Now they were actively traded on the stock market, and the valuation went higher. And over time, we did have to trim that position a bit. We probably could have stayed in it a little bit longer, but definitely a huge value creating event for the trust and its unit holders. So very good. Now, I mentioned earlier, we do invest in individual private companies. We try to strike an appropriate balance between our sponsors and taking direct positions. Taking direct positions can be very exciting, but also a little bit potentially risky. And so you really want to make sure you have a good understanding of the company, good understanding, and frankly, a lot of confidence in management. That's extremely important. And you want to have in your mind some sort of an end game or change of ownership or exit type of strategy that you can really clearly see looking out. Otherwise, you can get caught up in investments that don't perform so well. So this is a selection of some of our private companies. Again, not suggesting you contact them and go out and make an investment yourself. These are already in the trust. So again, one unit of the trust is going to give you access to these companies. Now, this is Jarissa. This is a international bank that we are literally right in the process of launching, and it is going to essentially make loans for the litigation finance industry, which some people didn't even know is a thing, and it is. And really, with litigation finance, there's two kinds of mechanisms by which you can invest. There's a litigation finance fund, which you can buy units of the fund and do it that way. Or you can start up a bank as we're doing with a group of fellow investors. And really, the value here is the return potential, or the torque, the upside lift. Banks can lend out a lot more money relative to their deposits than funds can. We are just sort of in the process of submitting our final application to the Financial Commissioner's Office in the state of Puerto Rico. Why Puerto Rico? There's a couple of reasons why we launched there, but I would suggest that the most important is regulation. That is a jurisdiction that is a little bit more friendly to what it is that we're doing. And it's not to say that it's any less stringent. We have had to file, and I can personally assure you that I have personally had to file inch-and-a-half thick paperwork with the commissioner's office to help get that banking license. We think we're very, very close, and it's exciting because if this works out, this will be one of a very small number of banks that are able to actually say we have a banking license to go out and make these loans. So really excited about that. And again, from an alternative asset perspective, litigation finance, um, not highly correlated to stocks or bonds. So it's a great source of portfolio diversification. Speaking of which, this is Real Vision, our financial media and knowledge company. It is headed up by a fellow called Raul Paul. Raul has been in to do webinars for us in the past, and he's great. And I mean, you can YouTube him or go to Real Vision's website and check out what they have going on. It is exciting. This is Telemax. It is another company that we own, and what Telemax is Canada's fastest ISP or internet services provider, and groups like PC Mag have done their individual testing, and it's not even close when you compare the speed of Telmax's networks to the incumbents. It almost looks like a mismatch. And so right now with Telmax, it's really all about scale. They just recently launched in the communities of Newmarket and Aurora, just up the 404 highway from downtown Toronto. And they're very excited to have made some inroads there. How we got to find out about Telmax was through an express regulatory approval by the CRTC, which is Canada's telecom regulator. You do need their permission to go out and start wiring up communities and billing clients for the services. And so, as I understand it, the city of Oshawa actually approached the CRTC and said, our consumers and businesses demand this, they want this, we need it. And this was really punctuated by COVID when a lot of people were at home. They needed their internet to do work and to communicate with loved ones. So we're really excited about Telmex. It is at a stage in their development right now where they've gone ahead and basically gone to the next level and brought on Mike Strobel, who was the former CEO of Allstream. And so we are sort of at that level now where, I think the networks have been laid out, the foundation is there, and we just got to scale. So that's one of the exciting companies we have. Another really exciting company is Grata, which is going to be your smart living home operating system. They are perhaps the single newest or youngest company in the entire alternative program, and they got off to quite the start. So we are a shareholder in Grata. Very pleased with the reporting thus far. There are constantly updates I'm getting about this company, and again with where Grata is, I think right now it's again all about scale and getting in through literally as many doors. This is a real estate company, by the way. It's a real estate technology company, is the way you want to think about it. And how we found Grata was really we looked at our real estate program and said there's certainly nothing wrong with it, but what can we add to enhance it to make it even better? And Grata have definitely done that. It is a new company, so potentially a little bit risky. Not suggesting anyone go out and buy it personally, but again, a mix of foundation and some upside there. Cash today, our short-term loan and title business out of Edmonton. Alberta. This is one of the most profitable companies that we own, and what Cash Today does is make short-term financing accessible to people who not just necessarily have great credit, but maybe are entrepreneurs. They're new to the country, they're new to the area, they haven't established themselves, and so this is a family-owned business, second-gen family-owned business that really, I think, knows how to operate the individual retail outlets extremely well. And to me personally, as a portfolio manager, just really, really precision focus on the performance of the loans. So that's what I like to hear. Obviously, there's going to be a certain percentage of these loans that are not performing. So again, what are the procedures and policies and risk management tools that they have in place to get around that? Very excited. And they did do a deal with Canadian Tire. Of course, Canadian Tire, the big Canadian retailer that when I was a kid had their own currency. So if you're in Canadian Tire and you're getting your car repaired, there is in some Canadian Tire locations an option to access Cash Today financing if you need it. So that's really exciting. And then just moving on to a few more global solutions team. This is one of our really, really cutting edge, high tech consumer product companies, mainly focused on travel rewards, hotels, bookings, um, airline reward programs, that sort of thing, founded by a real, A-level industry executive, and they are doing things that we are excited about. We are behind an NDA just in terms of some of the news that they're actively working on right now. I'm sure you'll hear about it in the coming quarters and years. But I can tell you it is all great. One of the newest companies in the portfolio we took a small position in is Pilot Coffee Roasters. We are in the coffee business now officially, and when we took a look at the opportunity set here with Pilot. The specialty coffee business is really interesting. Everybody thinks it's Starbucks and then Tim Hortons, and then that's kind of all you have. And really, with Pilot, the company was formed by a family who actually remain quite active in the business. They do control a considerable chunk of the business, and it's been in operation for about 15 or so years. And if you live or work in Toronto, you'll know that they actually started up in the Toronto neighborhood of Leslieville. But we just think that, this is an opportunity to really take this company from kind of a family-owned, family-run startup type of business to the next level. And we feel we might have caught a break here with some of the challenges, maybe some of the slippage that Starbucks is seeing, and some of the maybe dilution that you're getting kind of further down the spectrum in terms of Tim Hortons and some of the other coffee shops that you might frequent. So really perked up on that. I think the the last thing I need is more caffeine in my life, but here you go. We got it. Exits. We do frequently have exits in the alternative program. A lot of the exits that we have are going to be through, again, our private equity sponsors. So one of our private equity partners in the industry will sell a company to another company. And a good example of that was a company called Turn It In, which was essentially a plagiarism type artificial intelligence business that was sold to Advanced Publications about 3-4 years ago for a pile of money. That was through a partnership that we had with Georgian Partners. Georgian Partners is a very trusted ally of our firm. We really appreciate the sort of deep technology understanding that they bring to the table. This was an example of a company that our business found on its own. It's called 3IQ, and it was Canada's first uh, licensed digital asset manager. So this was one of the first funds that we know about that was able to create a fund structure, jam it full of Bitcoin and Ether, and then sell units of the fund for investors to buy. So we didn't feel that we knew enough about what Bitcoin or Ether or any of the other applications were doing. But we knew we wanted to make our investors some money from that excitement and from that sort of whole cryptocurrency and blockchain type area. And so we took a stake in 3IQ years ago. And this Japanese group, Monix, Japan, obviously one of the most friendly global cryptocurrency jurisdictions, snapped it up. It says December of 23, but the deal actually closed this April. So really excited about that. And so that is 3IQ. And then this is just another company with, I think I missed the timing of this webinar. Had it been coinciding with the Masters would have been great, but we the schedule wouldn't allow it. And so this is Encore Golf. If you are an avid golfer, you probably already know about their Bureau line of balls, as well as Elixir. There is a ball that they're working on, and I just can't remember whether it is top secret and confidential or not. So I'm not going to let the cat out of the bag, but I'm sure you'll be seeing that ball at clubhouses and fairways near you sometime soon. So again, just something really different from, what is the stock market doing? What is the bond market doing? What are interest rates doing? This is really a niche player in the golf ball field, and it's exciting. So that's all I'll say. I've used that word a lot. Let me just give you a cross section of some of our sponsors. I know they were listed on some of the tables earlier in the presentation, but I just want to talk about a few of them. So Brook Venture Partners, out of Boston, Massachusetts. They finance a lot of companies in the healthcare space. Now, this is not, medical equipment suppliers or biotech, drug companies, that sort of thing. These are technology companies that help medical practices, dental clinics, that sort of thing, be more effective at marketing their businesses, at running their business, at enabling their businesses to be more successful. It is an American type of venture, so remembering that, the healthcare system in Canada and the United States, a little bit of a difference there, but I'm very pleased with what we're seeing. And again, I'm sure you'll be hearing more about them in the future. XPB Water Partners, they were in to see us at an event we did last month in April. So if you want some more information about that, water really does impact everybody and everything. And what we really liked about XPV is we had thought about making a water investment again for a long, long time, and we just wanted to make sure that we're exactly right in terms of who we deployed the capital with. Multiplier Capital is a leader in growth equity lending, and then again I mentioned Georgian Partners as one of our really, really strong partners in AI or artificial intelligence. We have a ton of real estate in the alternative program. It's one of my favorite alternative asset classes, and sometimes is this the alternative portfolio manager or the real estate portfolio manager? We don't invest in real estate just because we like people's websites or, the glossy pictures of like $50 million buildings, that sort of thing. We invest in real estate because really that's one of the areas in the alternative space where your investment capital is very well treated. And so this is just a selection of some of our partners in the space: IFT Capital, Connor, Bridge Investment Group, and Ventera. They really bring us deals that, allow us to say to you, our investors, and again, prospective investors, we found something that people need. This is in demand. We completely understand that interest rates have gone up and that mortgage financing and cap rates and all of those things that ultimately are your cost of capital have gone up. But again, if you're in real estate that people are going to need or buying something that is going to be needed in the future, you're probably going to do okay. And in the case of Connor, they are our window into the Mark Twain world of land, right? Invest in land because they don't make any more of it is the quote, I believe. But again, it's a diversified real estate approach, and these are some of our partners in the area. Again, we really like them. Many of these partnerships are on their third, fourth, 10th fund. Again, they don't really get to this level by accident. So I think that's it for the formal slide presentation. This is our contact information. I'm going to leave it on the screen here for a few minutes, and then maybe Ken and I can just sort of have a quick discussion, the old fireside chat, as it were, and address anything of interest. So, Ken, maybe at this point, I'm going to stop sharing, and we are on this new, I guess, application called River, which is really exciting to be able to do this. And welcome to my home office. Ken, you're newer with the company, but certainly not any less important. What are some of the things that you're hearing about in the alt space from your vantage point?
I mean, obviously, I guess a recent grad from university and learning about investing through education and just history, even in high school, taking financial courses and just the marketing information out there. Alternatives, obviously, a very underserved area still, and a lot of investors, I think, still are learning about them. So I guess, Joe, my question for you, for the listeners and the viewers later, is the major benefits of alternatives in a like a diversified portfolio. Why is one alternatives a great area to get exposure to in your portfolio? And why is alternatives a relatively a better diversification than traditional assets like money market funds or even bond funds?
Yeah, no, I mean, that's a great question, and like I say, right out the gate, you're at an area in alternatives that's traditionally been the domain of sophisticated investors. They see long-term focus and they mean it. And a lot of these provisions that we have in place, the 2-year hold, the gating, the investment time horizons, to a lot of investors, those might seem like negatives. And I get it. When I was younger, I would view that too, right? You send over your money and you can't always access it immediately. What's up with that? But what's up with that is really you allow the full investment cycle of a plan or a strategy, or in the case of real estate, some of those properties to come to fruition. And when the sponsor is not worried about redemptions, they can really dive into a project and get going on the project or on the business. And that's really what we want. And what we see out of that is if you're willing to make that trade-off, you do get a liquidity premium out of essentially being separated from your money for a period of time. We've never had a problem with redemptions, but again, we're asking for a 2-year hold up front for the trust. We made that very clear. If you need short-term liquidity, we don't. We appreciate your interest in the trust, but we really don't want you investing in it if you know you're going to need the money in a very short-term period. So what you get for that is the returns. You get the smoothness of the NAV, which you saw on that chart is a lot better than most of the developed equity markets that we benchmark ourselves against. The good news is you really are doing something different. And from a diversity perspective, some of the companies that we talked about today, there's a chance, and I mean this in the nicest way possible. Many of our investors maybe didn't even know they exist before, they got to being here. And I think that speaks to our innovation, not just myself, we're a team, but really our independent, ownership structure. We do not have a definitive agreement with an ownership group, be it a bank, insurance company, or another, asset manager that, says we can't do this. And so we really go where capital is treated best. And as far as we can see, it's still treated pretty well in the alt space. So
Awesome,
yeah.
awesome. I guess final question, just on because this is just a little introduction, especially to newer listeners and newer viewers of us that our marketing team will be distributing this to. I guess what kind of investors can invest in the alternative asset trust, and what kind of accounts can they access the trust through as personal and even institutional investors?
The good news is we've created a number of different unit classes of the trust, so the investor can really customize, how and when and how much to include it. We do have an exemption with regards to the accredited investor rule. So if you're one of our clients here at McNichol, we can include the trust in your portfolio without having you jump through the accredited investor hoops. We do need you to do the risk analysis, so-called KYC onboarding process that every investor of a licensed portfolio manager must go through. But it's accessible to ostensibly all account types, right? RSPs, tax-free savings accounts, obviously taxable accounts, and professional corporations and that sort of thing. So it's really flexible, and I just not to sound disingenuous or anything like that. It was a lot of work and a lot of expense that we had to eat in the early days to make it such. I mean, it would have been very easy to say this is too complex, forget about it. But we saw that this was important. I mean, this was something really important as part of an overall portfolio, and that's why we appreciate the opportunity of sharing this with people that have an interest.
Awesome. So I guess we'll wrap up this recording and
Yeah, yeah, I guess so. We'll wrap this up, and really appreciate everyone's interest, Ken, your help, and we'll do this again because I think it's great to sometimes just open things up and see what we're up to. The next edition of the Trust's quarterly commentary will be out in early July after the end of the second quarter. We look forward to putting that out. And as always, if you have any questions, do check us out at mcnickelasset.com. We have an info account there, as well as a toll-free line. Love to hear what you're up to. And on behalf of Ken Reid and myself, thanks again for your attention.